Hi, everybody. Welcome to another episode of the 7-Minute Takeover, where we chat all things acquisitions. We're your hosts. I'm Liz Prey.
I'm Eamon Gamble.
We're touching on an acquisition accelerator, managing cash flow anxiety post-close. So, Eamon, a lot of people come across this term, usually introduced in the LOI, that you're buying the business cash-free, debt-free. What exactly does that mean for day one, you take over the business, and now it's your operation?
Okay, good question. So cash-free, debt-free is a term that shows up in the LOI all the time. And that's a way of controlling the actual price of the company. So that's when you're discussing how much money is going to flow to the seller, how much cash they have to leave, making sure that they've paid off the debts, you're setting your expectations there. It does not dictate how you are going to run the company after the acquisition. So even though the seller's not leaving cash on the balance sheet, there is always the option that a buyer comes in and brings cash with them to put on the balance sheet. So it doesn't stop you from doing that.
And from day one, you've got expenses that you've got to cover, and you're operating from day one. So as soon as you take over, there's some cash anxiety there. So where does this pressure exactly come from that people should be prepared for?
Yeah, there's a few key reasons why you might be under cash strain early following your acquisition. So one is the working capital peg. If for some reason you end up owing money at the end of 90 days because there was too much working capital in the company when you took over relative to your peg, or maybe your peg was just too low, you're going to end up owing money to the seller. And so you got to prepare for that. The bank's going to be aware of that is due. Secondly, there could be issues with good problems, growth, where you've got a bunch of orders, your inventory cycle is long, you need a lot of lead time to go out and order inventory. And so in anticipation of that growth, you need to actually start plowing cash flow.
Spending, it's not coming back in yet.
ARs are growing, but that's not cash either. You're waiting for that. So growth can actually cause quite a few cash flow challenges.
And for the most part, you can model that before closing, right? Anticipating seasonality or, your buying cycles, that sort of thing. You should kind of see that headwind.
You absolutely should, and in a lot of cases you will, which maybe gives you extra incentive not to start on day one with zero cash if you know that that's going to be a problem.
Absolutely.
And then the third one would be actual kind of the more negative scenario, which is where business declines. You just don't see the cash conversion cycle that you were anticipating earlier on, but you've got those loan payments to make.
Yeah.
And so you've got a big debt load. You're trying to make those loan payments. EBITDA's a little lower than you expected, and so there's a little bit of a gap in cash flow. That one's probably the most dangerous because that accrues over time and there's no obvious fix for that.
Yeah, that J curve after you take over operations, you're new, the clients aren't used to you. If there's any inconsistencies from the previous owner. Okay, so what are most people doing in these situations when it comes to managing this situation?
Right. So the first thing, and the thing that everybody should absolutely do, is when you're speaking with a lender about the acquisition loan, you should also be looking to speak with them about an operating line of credit. Operating lines of credit in the commercial space are typically used to finance accounts receivable and inventory. So if the cash deficit is the result of, hey, my ARs are growing, revenue's good, I need to buy inventory, that is a situation where your lending partner should step in to assist you. They set up those operating lines of credit specifically to support the working capital cycle. They do not set up operating lines of credit to help you manage cash flow negative situations.
So you want to have that line of credit set up before closing, right? You don't want to have to go back to them as part of the facilities in the lending package.
Yeah.
Because you don't want to be applying for that line of credit when you're in a crunch afterwards.
No, certainly not. No, certainly not. I think so that's one thing that I think most people are doing. Is talking to their bank, or the bank is proactively offering an operating line of credit if you qualify. And so a lot of folks think, okay, that's enough. I've got 500 grand from the bank. What could go so wrong that I need 500 grand right away? And while that's not the wrong view to have, that is why the operating line is there. You also need to think from the perspective of your lender. It could cause potentially a contentious relationship very early on in your relationship.
Why is that?
Well, if you are day one into your operating line for $300,000 because of cash flows negative, need to make inventory payments, all of a sudden the lender might suspect, hey, they didn't really plan well coming into this acquisition, that they needed to get $300,000 of our money immediately after close could signal to a lender, hey, this isn't going exactly how we thought it was going to go, rightly or wrongly. But it's potentially a way of just starting off the relationship with your lender on the wrong foot.
But there's still not a whole lot that can be done at that point, right? Like, you're in operations, you've got the facilities, you've got the loans, now you're in operations. Could put some pressure on the relationship, but
yeah,
ideally you're going to move through that.
Absolutely. This is more for if you're needing to make a request of them 6 months and a year down the road for expanded facilities.
So it's kind of the long.
They're thinking in the back of their head, hey, are they telling me the right thing, or are they going to need 300 grand more than they told me like last time?
Right. Yeah. You're building that trust and those habits from the beginning. Okay. So what's best case scenario? What is the most proactive thing to be doing to prepare for a potential cash anxiety?
So what we haven't highlighted, so we've highlighted the operating line of credit. You are allowed to bring your own cash onto the balance sheet. And so let's say you're paying $5 million for a business, you pay the seller $5 million, but maybe you bring $200,000 of cash above and beyond the equity needed to close the deal to put on the balance sheet. That gives you 200 grand of buffer. You could make a big inventory order. You could suffer some cash flow losses early. You could make that working capital peg payment, all without needing to necessarily dip into your operating line. Or if you do, it's to a much smaller degree than you would have without that cash. We are starting to see search funds recommending this to the buyers that they're investing in. We are starting to see more individual buyers just planning to have a little bit of extra liquidity on the balance sheet. It might reduce your returns. If you look at your IRR, it might have dropped by a couple of percentage points because you needed to put the extra money in. But the likelihood that you're still around in 5 years probably went up 20%.
Absolutely.
So
absolutely.
it's what do you value between those two things?
So we're seeing people not deplete their cash reserves with their in the purchase itself with their down payment, leaving a little bit of a buffer there, or over raising if raising capital from investors is what I'm hearing.
Yeah, because some people might say, hey, I've got some cash myself. I can put it in if necessary. But that's not necessarily going to signal seriousness or prudence to, say, investors that you're trying to raise money from, lenders that you're trying to raise money from, even sellers in positioning that you're a prudent buyer. Pre-planning to say, hey, I don't know if I'm going to need this 200, but I'm going to put it in the business anyways.
Yeah, it's not in every case that you're going to need it, but it's going to give you that peace of mind as well, and make sure that you're feeling safe and secure in your operations.
So plan well, get an operating line of credit, bring some cash to the deal, and that should put those post-close cash anxiety blues to bed.
Yeah, you have enough to deal with. You don't need any more stress to manage.
Yeah.
All right, thanks, Eamon.
Thanks, everyone. See you next time.
Thanks for tuning in. If you enjoyed the content, please be sure to subscribe, follow us on social media, and check out our website at villagewealth.com.